Let's talk about self-insurance and the mistakes that people make with their protection decisions. Let me put it this way. I've never met a person who, when they've had an insurance claim, tells me, you know, I really just had way too much insurance. When that moment comes, whether it be a car accident or a fire that burns your house down or a death or a disability, people instinctively want and appreciate a large amount, a significant, a maximum amount of insurance protection. I've learned this to be true in almost every client situation. It's really the cost of insurance that is at issue, not the notion of insurance itself. If I were to be your employer and I proposed that I was going to buy for you and pay for you a $1 million life insurance policy, all you had to do was check the right box, yes, I'll take it, sign your name, and the insurance coverage would be in place. As long as I was paying for that protection on your behalf, what would you decide? Which box would you check? Like most people, I'm sure you said, well, if you put it that way, of course I would take the additional insurance protection. You wouldn't need to crunch some numbers or do a financial plan or decide whether you needed it or not. You wouldn't call your CPA or listen to somebody on TV counsel you about how much life insurance. You would just go ahead and take the insurance that's being provided by me to you. And what that proves in my mind is that insurance is something that we all want. Insurance should be the foundation of your financial picture. It's the first step, it's the first thing to consider. With the living balance sheet, what we tell our clients is that we don't set out to tackle and address your tomorrows while leaving you exposed against what might happen today. By subscribing to a protection-first theory, surprises in life will not derail your financial futures. The other elements of a properly designed protection portfolio is one of maximum amounts. So many people have limited or minimal amounts of protection coverage while at the same time overpaying for that coverage. And with the living balance sheet process, we try to reverse that and lower your protection costs while increasing the amount of coverage that you have in every area of your life. There is a maximum level of insurance that can be owned by you, and you have every right as a consumer to know what that amount is. The same car, if it was stolen or totaled, the same house if it were to be burned to the ground, the same ring or piece of jewelry, the same amount of business inventory, the same life value. How much is all that worth? What is the appraised value so that you can now make sure that you have a level of protection that's equal to that value? The final component to a well-laid protection portfolio is lifetime protection. It is important that protection stay in place. There's never a point in time in your life where you'd be better served while self-insuring. The notion that you'll buy insurance for a little while and then someday drop it in the future is a recipe for financial disappointment. The idea that you could build up your balance sheet and no longer need life insurance, for example, is something that will end up causing you to have more taxes due, more investment risks, and less cash flow as a retiree. And yet the idea of self-insurance would have you looking in the wrong direction. Self-insurance is a dangerous way to think about money. It's also not ever going to be in the consumer's best interest to pursue a self-insured path. Not only should protection be considered first, and not only should protection be purchased in maximum high-level amounts, but it also should be that your protection thought process should include a lifetime of protection, with the idea being that you're never ever going to be in a better position by being self-insured, but always be better served by being fully insured on an ongoing basis.